Hello friends. Last week I basically discussed about how volatility has spiked, and since the last 2 weeks I have been telling you that your hacienda hedge or tail risk hedge was the only way to go forward because of the elevated levels of volatility. I even wrote in my Live Mint column, which is India's first and only media column to present statistical data to its readers, that the markets may make outsized moves, but retail traders will find it extremely challenging to garner trading profits. And that is exactly what happened. Now, as usual, the banking and financial sector stocks, which command a lofty 33% weightage in the markets, basically dragged the entire market lower due to the sheer selling pressure in these counters alone. What is likely this week, in the coming week, and where do we seek profit making opportunities? This video is all about that bit, and coming up on your screen is the market weekly roundup window, which tells you that the bank nifty fell further and faster than the Nifty 50. The US dollar index rose by 70 bips, and that basically pressurized natural gas prices and brought them down to under 9%. Remember, I've been telling you that gas on my Telegram channel. I've been telling you the European markets are oversupplied. The spot cargo delivery market is not indicating any panic buying. Crude oil went up because of the announcements by the Saudis that they are raising the official selling price, or OSP, for the month of April for Asian buyers. Gold fell on a strong dollar, and silver rose on short covering, which was against the tide of gold itself. Now, the Indian rupee, the INR, fell marginally against the US dollar. The Indian 10-year benchmark bond yield rose by 2 basis points, and the NSE lost a little under 4% in market capitalization, which tells you that the sell-off was fairly broad-based. MWPL continued to go up, which is routine after expiry, and it will continue to rise till the third week of the derivative cycle. The US indices continued to fall, and the technology heavy NASDAQ led the decline, and therefore that casts a shadow on domestic technology stocks here. Now, friends, I come to the Nifty versus the Bank Nifty. Here you can very clearly see that the Bank Nifty continues to remain an outperformer of the Nifty 50 on a 4-week time frame. On a 12 and 20-week time frame, of course, the Bank Nifty is underperforming. So what we are seeing is that 33% of the Nifty's weightage is more or less remaining outperformer as compared to the Nifty itself. So there is a semblance of short covering in the undertone, but we need follow-up buying in the banking and financial sector stocks before we can say that the markets will find their feet and start to rally again. What was also noticeable, friends, as you can see on the snapshot window of DLF, was that the bid and offer spreads. Notice how the buyer is at 828.35 and the seller is at 829.35. Now that is a big difference. I've made a video on how to interpret the spread quadrant, the difference between the bid and offer prices, and the difference between the best buyer and the second best buyer, or best seller and second best seller. Now, unless you have screen reading skills, you are going to find navigating through these markets extremely challenging, which is why you must watch that video. The hyperlink is in the description below this video and in the pinned comment below. Friends, I now come to our in-house indicators, starting with the MWPL, which shows a rise to 38.36, and that is lower than the last couple of derivative cycles in the commensurate week itself. That tells you that although buying continued from the swing traders, the two Marshmallow traders, and now the Marshmallow trading theory is again explained in a video in a pinned comment below and in the description below this video. Please do familiarize yourself with that. So risk appetite, although remained optimistic, but not as gung-ho as in the prior months. So that tells me that there was caution in the undertone. Now, friends, I come to the stock and index futures turnover. Remember, these are three cumulative series. So it is March, April, and May. Turnover was up. That tells you that there was actually participation in the sell-off. Now, when there's participation in the sell-off, that means selling pressure was there. The average trader out there was not only prepared for the decline, but he also profited from the decline. Of course, it is more of a savvy trader, the HNI or the smart or big money trader who's made money. The retail guy has actually left money on the table. Now I come to the advanced decline ratio that basically picked up a little but still remained under 1. At 0.98 compared to the prior week's 0.71, there were 98 gaining stocks for every 100 losers. Not exactly a great thing to happen. Do remember that the advanced decline ratio has been under pressure for the fourth consecutive week in a row by staying below 1. The Nifty, of course, has lost 2.09%, but the advanced decline ratio must stay above 1 continuously in all the trading sessions of the coming week. Now, friends, I come to the futures basis. Basis is nothing but the premium or discount prevalent in the future compared to spot. What you're seeing is that the basis for the Nifty went up and almost doubled. That tells you short covering came at lower levels to cushion the Nifty, whereas the Bank Nifty basis continued to fall. That means there was pressure at higher levels. So do remember, I've been telling you that banking and financial sector stocks, due to their sheer weightage alone, are likely to drag the markets lower. And here again, the basis of the Bank Nifty is something you must watch very keenly in the week ahead. Friends, I now come to our in-house exclusive indicator, the impetus. You won't find it anywhere else on the internet. The impetus for both Nifty and Bank Nifty fell, which tells you that both indices have logged declines, but on less than forceful volumes. The reason being A, the high base effect, which is why the impetus appears lower, and secondly, the retail trader, an average retail trader, actually goes into a state of shock and trades less when the market starts to fall. So the force came only from the HNIs and smart money. Friends, I now come to the lift weight thrust drag index. Here again, it's an exclusive indicator. You won't find it anywhere on the internet. The LWTD fell to 0.17 from prior week's 0.29. What does it tell you? That the fact that the Nifty has recorded 2.09% declines and the LWTD has also fallen, it tells you that fresh buying support at lower levels might be milder compared to the recent past. Of course, short covering will continue, but I continue to repeat what I have been telling you this far. Short covering cannot trigger a fresh rally. It is fresh buying that triggers a fresh rally. Yes, short covering can cushion declines. They might slow down the declines, but you need fresh buying. So LWTD and the price must rise together if the market is to rally significantly. Friends, our in-house indicators done. I now come to the bond market, and this is a very critical bit of information that you must pay attention to this segment particularly well. Now note how on the weekly chart on your screen, the Indian 10-year benchmark bond yield has closed at 7.06%. It's a level you've not seen for 3 weeks on a weekly closing basis. With what's going on in the market in terms of uncertainty in the sentiment levels due to the sheer volatility, adverse news flow, etc., I think it would be prudent that the 4 gilt funds that we've invested money in, as you can see them on the inset box in the lower end of your screen, we are still in the money, but the gilt funds are way below their life highs now. They are off their life highs, and due to the cloud of uncertainty, not for any other factor, but cloud of uncertainty, I am contemplating, or rather I will not just contemplate, I will exit the first tranche of GILT funds that I have basically recommended on 14th of December 2023. We can always enter again later. There is no statistical data available that will tell you that things have gone nasty. But this is me just playing it safe. You can, of course, feel free to differ and choose to act as per your convenience. But I'm thinking of taking some money off the table and converting to cash. Friends, the bond market's done. I now come to the bank nifty, and as you can see on the daily chart on your screen, this index has fallen on all 5 days of the week. The price has closed below its month-long moving average, which itself has turned downwards. The erstwhile resistance at 46,250 levels has held as an intraday support on Friday, but this needs to be defended proactively by the bulls if at all the fall is to be controlled by the market forces. If not, if the bank nifty continues to fall and trade below 46,250, further downsides cannot be ruled out yet. Also note how basically the bullish wedge that has formed, marked it by two converging red trend lines. We are below the wedge bottom, and that basically tells you that bulls appear to be nervous at this point in time. Let me remind you that with the 33% weightage in the Nifty, banking and finance stocks can make or break the market sentiments. And moving on to the weekly chart, what is apparent, the first thing that you see the weekly chart is that last week's candle, the bearish candle, was a power candle. That means an outsized, huge, prominent candle. That tells you the extent of selling pressure that was present in the market on the bank nifty. The price remains above its 25-week month-long, 25-week 6-month-long moving average, and that tells you that the medium-term outlook remains optimistic, but only for now. Should the price trade consistently below this average, I'm afraid bulls are going to be under pressure in the near term. Now, the top made a fortnight ago at 48,161 level is lower than the top made at 48,636 in the end of December. That shows a lower top formation. Now, bulls must act now and must kind of support the bank nifty or risk further falls. If the bank nifty is to turn bullish, a breakout above the 48,161 level is a critical event to watch out for. Friends, in the week before last, this index was number 2 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It jumped 3 notches to number 5. Volatility coming down is a welcome thing, but has the volatility actually come down? I don't think so. I think the volatility in individual stock futures has jumped significantly faster. Therefore, you feel the bank nifty has become less volatile. It's not. Volatility in the bank nifty compared to itself has actually gone up. Last week, I advocated a range between 49,250 on the upside and 46,425 on the downside, which was violated by 115 points because the intra-week low in spot was 46,310. In the coming week, I estimate a range between 48,000 on the upside and 45,175 on the downside. Friends, in addition to these levels, please do watch the daily, weekly and monthly pivot levels that I update on our free Telegram channel. That will give you a better handle on where your support levels exist for intraday swing and buy and hold kind of traders. Friends, the bank nifty done. I now come to the Nifty 50, and as you can see on the daily chart on your screen, the Nifty 50 has fallen on 3 out of 5 trading sessions as compared to 5 out of 5 trading sessions of the bank nifty, which means relatively speaking, the nifty seemed to be comparatively stronger compared to the bank nifty. The price has closed below its month-long moving average, which happens to remain sloping upwards as of now. So there is a mild concern. The bigger issue here is The Fibonacci 261.8% extension level at 22,200 levels has been violated. The closing is below that level, and unless the bulls take the Nifty past this level, I think we are likely to see some selling pressure continue to remain present in the market. Now, as you can see on the chart, Wednesday's candle was the most prominent one. This is where bulls actually surrendered and capitulated from their long positions. If I was to peel layers and layers of statistical data from the price itself, I noticed that the ticket sizes per trade, TSTs, were higher than average on the Nifty and the Bank Nifty as compared to recent average TSTs. That tells you that there was concerted selling pressure. And this study and this aspect of the market would greatly excite all savvy statistical minded traders, because now you know where moves above two standard deviations in terms of volatility capture are coming from. This is why I've been telling you that in 2025 you must prepare yourself for highly volatile markets, because it's going to be a pro-cyclical hysteresis markets, and intraday price movement is not something every retail trader will be able to handle. Here again, I would remind you that the spread quadrant has turned hostile. Do refer to that video on how to watch for spreads. Only a breakout above the 22,525 level will confirm a bullish bias to return in the market. Turning to the weekly chart on your screen, here again, like the Bank Nifty, there is a bearish power candle which shows the extent of selling pressure. Note how the four prior bullish candles were actually hammers. Now, this is something I've also covered in my weekly live mint column. Do make it a point to read that column. I share the hyperlink on our free Telegram channel here. Now, hammers indicate that the price opened up but fell on a weekly basis only to pick up at closing levels, which means bulls so far defended their positions for the prior 4 weeks. But the fact remains that 4 consecutive candles told you that there was heaviness at higher levels. Sure enough, it culminated into a sell-off last week. There was, of course, the news flow which was responsible. There was also the warning about an asset bubble in the market that triggered a decline. But volatility, like I have been telling you, irrespective of whatever happened in the market, is up, is going to remain up. And there's only one thing that you can do is to skill yourself up and prepare for highly volatile markets. Now, the price is above its 25-week exponential moving average, so the medium-term outlook is positive for now. Note how the wide gap between the price and the moving average, which I had indicated as a reason for consolidation or mean reversion, has actually lived up to its expectation, and the Nifty has come down in price. But as long as the price remains above this moving average, the outlook still remains optimistic, and I would expect that 21,200 levels on the Nifty to remain a significant support to watch out for. Friends, in the week before last, this index was number 10 on our most volatile counters list. It slipped 2 notches to number 12. Here again, I put forth my hypothesis that individual stock futures volatility rose faster than the Nifty, which is why the Nifty appears to be less volatile. Remain assured, the volatility was above normal. Last week, I estimated a range between 23,000 on the upside and 22,000 on the downside. The low made was 21,906, which means it fell 94 points more than what I expected intraday, of course, and closed at slightly above 22,000 levels. In the coming week, I estimate a range between 22,500 on the upside and 21,525 on the downside. Please do refer to our daily, weekly, and monthly pivots on our free Telegram channel to help you trade better. Now, friends, I come to the retail risk appetite, which is indicated by the 4 segments of the derivatives marketplace, and the index futures show 0.06% increase in turnover contribution as shown by a blue line. The stock futures turnover contribution went up 0.10%, which is indicated by a red line. Now, friends, stock futures demand more money, are more volatile. They are more prone to basically demand mark to market losses, extreme loss margins, concentration margins, etc. In spite of the fact turnover contribution from the future space was higher. That tells you that the high net worth individuals, the savvy big money traders, were actually participating in the selling process. I'm not so sure about the average retail guy. He was too frightened last week, as the statistical data tells me. In the relatively lower volatile option space, index options saw a 0.65% decline in turnover contribution. I've indicated this as a green line. And stock options turnover actually went up by 0.50%, which is indicated as a purple line. So net risk appetite was definitely higher last week, and it tells me that an average trader was basically attuned or reconciled himself to the fact that the markets were going to fall. The retail guy didn't participate. The HNI guy definitely sold. So turnover went up. Friends, I now share my strategy with my online family in this video. Last week, I told you that I had experimented with selling oil marketing company stocks, and the results were surprisingly and scarily profitable. What you saw last week, and I had my live mint column of last week was actually titled as Watch the Oil Marketing Companies. I had in paragraph number 5 of that column warned you that the span margins could be raised if volatility went up, and that is precisely what you saw in the span margins of Hindustan Petroleum, Indian Oil Corporation jumping through the roof. I told you that more than 3 to 4% intraday ranges could be seen. Prices will jump both ways, and hey, on Friday you saw almost 10% intraday ranges, which is not something that an average retail trader is geared, built, prepared, trained, or is ready to handle. Which is why your hacienda or tail risk hedges are a must in this market. Will I continue to trade PSUs and PSB? Hey, yes. Because that's going to give me volatility. As a trader, I want volatility. This above average volatility is something that I will try and trade, but with absolute caution on lower traded exposure. This, of course, is advice for extremely high risk, savvy, and experienced traders. I remind my online family about the spread quadrant being more hostile. Look at the snapcode window of DLF. What you are seeing is the yawning wide bid and offer spreads, and the spread quadrant, as professional screen traders, intraday traders call it, has turned hostile for an average Joe. I will continue to seek decay in oil and gas at favorable delta levels in the option segment, and banking and finance stocks will be more volatile than the others due to the reasons that I've discussed with you earlier, and will provide ample trading opportunities to a savvy investor and trader. Bullion might just see some amount of profit taking if the US dollar index continues to strengthen, but at lower levels, there's ample amount of support coming in, and I think the time ahead, as and when equity and forex markets get more volatile, there might even be safe haven buying in coming in bullion. Friends, I've advocated earlier to you about gilt funds. I am planning to temporarily exit out of the first tranche of gilts that I recommended on 14th of December 2023. I will come back and take a call again once the uncertainty present in the market due to whatever news flow that you are seeing in the recent past clears the air, and then I would basically keep the powder dry till then. I can always re enter at my own convenience. This is a week where I will focus primarily on capital preservation first and alpha or absolute profit generation as a second priority. If there are any more trading ideas, remain assured they will be shared with you first and foremost on our free Telegram channel. Do make it a point to join me there. The contact coordinates of my media accounts come at the fag end of this video. Friends, before I bid goodbye in this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what you think about our work and how it helps you become a better trader. Also, help me reach out to a bigger, wider audience of smart and savvy traders like yourselves by sharing my video with all your social media groups and friends. I thank you for your patience in being with me in this video this week. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.